In the fourth quarter of 2025, American households owed $18.04 trillion, credit card balances crossed $1.21 trillion, auto loan delinquencies hit levels last seen in 2010, and buy now pay later debt, the kind no credit bureau tracks, quietly ballooned past $100 billion. That's not the first time a consumer economy ran out of road, and we already know how the story ends. History doesn't repeat, it patterns. This one is called the credit exhaustion cascade. When borrowed demand runs out, the crash isn't the disease, it's the fever breaking. Start with the story you think you know. October 29th, 1929, Black Tuesday. The Dow Jones lost 12% in a single session. 16 million shares changed hands. Fortunes vaporized. The Standard telling stops there. Stocks crashed, and the Great Depression followed. That telling is wrong, or rather it's looking at the smoke and missing the fire. Because by 1929, the American consumer economy was something entirely new. For the first time in history, ordinary households were buying durable goods on installment plans. Roughly 75% of automobiles were financed, about 80% of radios, washing machines, refrigerators, furniture. Most of it bought with a down payment and a promise. Installment credit outstanding had tripled in the decade. Consumer debt as a share of income reached levels that wouldn't be matched for another 40 years. And then there was the stock market itself. Investors could buy shares with 10% down. 10%. The broker loaned you the other 90. By September 1929, margin debt hit $8.5 billion. Roughly 10% of the entire United States economy. The equivalent today would be margin loans of about $2.9 trillion. When prices started falling, those loans got called. Investors had to sell to cover, which pushed prices lower, which triggered more margin calls. The stock market didn't crash because confidence evaporated. It crashed because the credit underneath it evaporated first. The same mechanism had run before, just without the stock ticker. Go back to 1720. London. The South Sea Company's shares rose from £128 in January to £1,050 by June. The Bank of England was lending against those shares. Private banks were lending against them. When the bubble broke in September, the loans broke with it. Parliament had to pass the Bubble Act. Isaac Newton, lost roughly £20,000, a fortune, and reportedly said he could calculate the motions of the heavens, but not the madness of men. Credit funded the rise. Credit exhaustion caused the fall. Jump to 1873, Vienna. The panic started on May 9th with the collapse of the Vienna Stock Exchange, but the real story was in the building loans. Austrian and German banks had financed a construction boom on paper-thin equity. When one Vienna bank failed, the chain reaction traveled: Berlin, Paris, New York. The resulting long depression lasted more than 5 years in the United States. 18,000 American businesses went under. 100 railroads failed. Same pattern. Credit inflates asset prices. Asset prices collateralize more credit. Somewhere, the loop runs out of new borrowers, and the unwind is always violent because leverage works in both directions. By 1929, America had industrialized the pattern. Installment credit reached the kitchen. Margin debt reached the middle class. The economy didn't just depend on consumer spending. It depended on consumer borrowing accelerating every quarter. When it stopped accelerating, it collapsed. The real question isn't why 1929 happened. It's why anyone thought it couldn't happen again. Because the pattern didn't stop there. An economist named Irving Fisher watched the 1929 collapse wipe out his personal fortune, about $10 million in today's money, and spent the next 4 years figuring out what he'd missed. In 1933, he published it. He called it debt deflation theory. The mechanism works like this. When an economy is heavily indebted, falling prices don't help consumers, they destroy them. Because debts are nominal. If you owe $1,000, you owe $1,000 whether a loaf of bread costs 10 cents or $1. But your income moves with prices. So when prices fall, your debt gets heavier in real terms. You sell assets to service it. That selling pushes asset prices down further, which makes everyone else's debts heavier too, which forces more selling. Fisher called it, the more debtors pay, the more they owe. Think of it like a crowded nightclub with one exit. When everyone's calm, the exit is sufficient. When everyone runs at once, the exit becomes the problem. Debt during good times is the crowd. Deflation is the fire alarm. The liquidation is the stampede. The structural reason this keeps happening is simple. Credit expansion feels like growth. For a while it is growth. Borrowed money shows up in someone's income, gets spent, becomes someone else's income, gets taxed, funds government spending. Every participant has a reason to want the expansion to continue. But borrowing pulls consumption forward in time. A car bought on credit today is a car not bought on credit 3 years from now. Multiply that across an entire economy for a decade, and you've borrowed against a future that eventually arrives. When it arrives, the borrowing must stop. When borrowing stops, spending falls. When spending falls, incomes fall. And the debts, still nominal, become unbearable. Every participant behaving rationally produces a collectively catastrophic outcome. Nobody wants the unwind. Everybody causes it. This is the part of the pattern that makes policymakers feel helpless, because they usually are. Which brings us to now. As of the fourth quarter of 2025, United States household debt stands at roughly $18 trillion. Credit card balances have crossed $1.21 trillion, with average interest rates above 21%. Auto loans total about $166 trillion, and serious delinquencies on those loans have reached levels last seen in 2010. Student debt sits near $1.77 trillion, mortgage debt is above $12.5 trillion, household debt as a share of GDP is near 63%. In 1929, it was around 50%, and that number shocked contemporaries who had never seen consumers borrow that way before. But the raw numbers understate the parallel, because the borrowing has migrated to channels regulators barely track. Buy now, pay later lending, Klarna, Affirm, Afterpay, has exploded past $100 billion in the United States alone, and most of it is invisible to traditional credit scoring. Zero-day options, which barely existed 5 years ago, now account for more than 40% of S&P 500 options volume on some trading days. Retail investors are using trading apps to take leverage positions on single stocks with borrowed money at rates most of them don't fully understand. That's the 1929 margin story, rebuilt in software. Corporate debt is at all-time highs, above $13 trillion. Federal government debt has crossed 120% of GDP, a level the United States has reached only once before, during the Second World War. Commercial real estate loans, concentrated in regional banks, are rolling over at rates double what they were underwritten at. As of early 2026, reports suggest that office building valuations in major metros are down 30 to 40% from 2019 peaks. The policy response after 2008 prevented a deflationary cascade by flooding the banking system with liquidity. The response to 2020 went further, roughly $5 trillion in fiscal stimulus, direct-to-consumer checks, near zero interest rates. Both responses worked, in the narrow sense that the nightclub didn't burn down. But they didn't reduce the debt. They transferred it. From banks to governments, from corporations to central bank balance sheets, from institutions to households. The crowd in the nightclub got bigger, the exit got no wider. Fisher's mechanism is still there, waiting. The only question is what triggers it, and whether, this time, the usual fire extinguishers still work. So, can the pattern be broken? Historically, 3 exits exist. Deflationary crash, the 1929 path, which ran for a decade and cost 25% unemployment. Inflation, the 1970s path, which silently transfers wealth from savers to debtors but destabilizes a generation's retirement. And default with restructuring, the emerging markets path, which is fast but brutal. The cases that worked best weren't escapes, they were managed unwinds. Sweden in 1992 nationalized its failing banks, forced losses onto shareholders, recapitalized cleanly, and recovered within 4 years. Japan chose the slow unwind after 1990, 30 years of stagnant growth, but no collapse, no social breakdown, no political rupture. What those cases shared wasn't clever policy. It was institutional trust and political willingness to impose real losses on real people in real time. Both are in shorter supply today than at any point since the 1930s. The pattern isn't unbreakable, it's just rarely broken, and never by wishing it away. Pattern confirmed. The credit exhaustion cascade doesn't care about your portfolio. It cares about the math. Now I want your take. Do you think this same pattern is unfolding today? Or is this time truly different? Tell me your perspective in the comments. I'll see you in the next one.